I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB.
Who are you?
Bond. James Bond.
No.
In this video, we're going to take a look at one of my favorite tools, the Portfolio Visualizer. It's a free, semi-free tool that you can use to backtest portfolios, see how stocks or sectors have done over time. There's a free version that you can access. That's the one I'm using. I don't pay for the other ones. I don't need all the extra features. Or you can pay $19 a month or $39 a month. There's a lot of extras you get, but the free version works fine for me. So let's take a look what we can use this Portfolio Visualizer for and what I'm using it for, and I can tell you what value I get from it. As you can see here from the front page, there's a lot of different things that you can do. You can backtest portfolios, you can do factor analysis, asset analytics, you can run Monte Carlo simulations, you can try to optimize your portfolio, seeing what has done, what kind of sectors, what kind of types of portfolios have done the best over time. And one of the interesting one is the timing models. I haven't used that a lot, but it's very interesting. The first and foremost thing I use it for is to backtest different stocks, different portfolios, and different sectors. Let's see how I use it. So I pick the backtest portfolio. And the first we have to figure out is what time period do we want to go? Do we want to go from full year to full year, like here, 1985 to 2022? Or do we want to go for a specific month in a specific year to a specific month in another year? I usually use year to year, but it's very nice to be able to do the other ones too. For example, you want to see how things have done up to a specific crash, and then maybe factor out the crash just to see what would have happened if that had not happened. So that's what you can use the month to month to. The next thing we have to take into consideration is year to date. Are we going to include the date we set to exactly year to date, or what are we going to do? So this means that we're, instead of going month by month, we're going to the exact date. Usually I don't really do that, but it depends what it looks like. Initial amount is the amount that we put in the portfolio at the beginning. Cash flows, here you can set if you contribute something, if you withdraw something, that's actually very interesting, or if you withdraw a fixed percentage. For instance, if you have a portfolio, you would like to see what would have happened if you were retired and pulled out 4% every year from this portfolio. How would that have looked? So, very nice tool to have. Then there's the rebalancing, as you're setting percentages for each thing in your portfolio. Like for instance, if you said that Tesla is supposed to be 10% of your portfolio, and Tesla all of a sudden grows exponentially and becomes very, very large position, well, then it will rebalance it, so it will only be 10% of the portfolio. Then we get to leverage type, how you can leverage your portfolio. I really don't use that at all. The reinvest dividends, that's really nice to have, that if you have something that pays out dividends, this will be factored in as if you reinvested them in the same stock. Pretty cool feature. Display income. Display income will show what you have earned in your portfolio, showing your dividends and distributions and what there had been in the past. Let's set that to yes. Factor regression, it shows you the risk that you would have had in that portfolio. And the benchmark, well, it says itself. You can specify against another stock. You can specify against the S&P 500 or a balanced index. If you pay for the better versions, you can import other portfolios and stuff. I usually just benchmark against the S&P 500. Portfolio names. Here you can set the names for the portfolio. It's nice to have. So, fun sake, let's just try to compare two different stocks over time. Let's compare Pepsi. And portfolio 1 has 100%. It's only Pepsi, because I only want to compare Pepsi against Coca-Cola. Then we take Coca-Cola, set that in portfolio 2, 100%, go down, analyze portfolios. Now, the portfolio visualizer will tell us that, oh, wait a minute, we only have data for Coca-Cola from 1985 until now. So the data is from there and not before. But that's fine, it doesn't matter. I usually don't go so far back. And as you can see, we get our great results here. If we had invested $10,000 back in 1985 in Coca-Cola and $10,000 in Pepsi and $10,000 in the S&P, today Coca-Cola, Pepsi would be about almost $1 million, 960,000. That's compounded annual growth of 13.24%. That's damn good. Standard deviation is about almost 20, and the best year it had was almost 65%. The worst year was almost 26%. And the max drawdown, the max that it had declined, is about 35%. The Sharpe ratio, it tells us something about how volatile it is. It's about 0.58. And the Sortino ratio, I'll get back to that later, 0.71. And market correlation is 0.54. So, from 1986 actually, until now, the winner in this little portfolio stock contest would have been Pepsi. 13.24% compounded annual growth, 12.49, and the S&P 10.28. And as you can see, we get a nice little graph here where we can follow each year for each stock, see what happens, see how it looks like. You see here the great drawdown there was. This was in the great financial crisis. You can see how much the S&P 500 was hit. It really didn't hit Coca-Cola and Pepsi that hard, but we can look at that later. And then we can scroll down and see the annual returns. See what year returned what. Look, this one is an interesting year. You can see Pepsi was minus, where everybody else was doing fine. Something happened there, 1994. And the same with some of the other years. Of course, we all know what happened back then, 2008, 2009. And right now, everything's getting hit. So, yeah. You can scroll down, see what the total return was, with months, with year, how the investment has fared over the years. Here is the portfolio income. That was the one I talked about earlier, where you can see how much money you would have gotten in your account. I think there's something wrong there in 1997. Something does that Pepsi goes off the charts. I don't know what it is, but it looks weird. And then you can begin to look into some of the other metrics, some of the other things that this portfolio visualizer can. You can look into what the portfolio is exposed like. It's simple now. It's only stock versus stock. So of course, that's 100% stocks. Then we go to the metric tab. Here we can see everything. I mean, standard deviation, beta, Sharpe ratio, Sortino ratio, the trainer, everything. This is really, really a deep tool if you want to use it right. I usually don't go that deep for this. I usually just look at the returns, the drawdowns, the percentages, and stuff like that. We always got to remember that we're looking at past returns here. So nobody says it's going to be like that in the future. Past returns doesn't equal future performance. But still, it gets a picture. And if you have an idea about how much the companies you're looking into will grow, you kind of know if it's going to stay on course or it's going to go fast or up or more down. It's kind of you get to know that when you've done this in a long while. We can go into monthly returns, see which month did what, or the drawdowns to see which year has been major drawdowns. And we usually know this, but still interesting to look at. And one of the things that I look for here is when there's a large market downturn, how did the stock I am looking at, how did that perform? Then we can look at just the assets. What is it? What did it do? The compounded annual growth, the things we saw on the front page. We can look at rolling returns for the year, 3, 5, 7, 10 years. don't really use that for much. It's not so interesting. My interest is in the first page, actually the summary page. My interest is in what is the compounded annual growth, what is the standard deviation, what is the max drawdown, and what is the market correlation. Those are the ones I really look at the beginning. And especially the drawdowns, I go to look at the drawdowns tab to see what happens during recessions. How did this company perform? What did it do? Now we have looked at 2 stocks. Let's just see, what should we take? Let's try to look at some of the other great features that this portfolio visualizer has. When we look here at the portfolio where we put in the percentage, they built in a really, really neat function. You can click on the tab and you can see some preloaded portfolios. For instance, the good old, well-known Ray Dalio all-weather, all-seasons portfolio. Actually, it's called all-weather portfolio. I don't know why they call it all seasons. If you hit that one, the visualizer will automatically choose the corresponding ETFs at the correct percentage. So all you have to do is analyze portfolio. And here now you can see why it's a good idea to make the custom name, because it just calls it portfolio 1. So here you would go up and enter the portfolio, call it Ray Dalio all seasons. And now we can see the data for one of those ETFs is capped at 2006. So our data can only go back to 2006, and that is a big problem, the inception of the fund, of the ETF. So you can't go further back than that fund. But just as before, we get a nice pie chart. We can see how much each ETF has in the portfolio, how much the allocation is. We can see how the Ray Dalio all-weather portfolio would have done if we invested 10,000 back in January 2007. It would have given us 5.38 compound annual growth, and the S&P would have gotten us 8.10. So in this period, from 2007 to 2022, it would have been better to invest in the S&P 500. And this is what we can learn from it. We can learn and see, has that time period shown us anything that would make us want to invest like that one? I mean, we can go to the drawdown tab and see what happens here back in the financial crisis. Well, you can see that the S&P 500 goes down way more than the Ray Dalio portfolio. But still, when we then go back and look at the chart, we can see that even though that the S&P 500 fell a lot more, it also climbed a lot more. And especially when we get here to 2015, 2016, it climbs a lot faster. And then again, boom, COVID hits and it tanks again. Ray Dalio's portfolio is more linear. It's slowly growing up there. But what do we want? Do we want security or do we want growth? Well, that all depends on your risk factor, who you are, your timeline, strategy, everything. So let's try another one. So if we have a portfolio like the Bogleheads, let's take the Bogleheads free fund portfolio. It's 50% of the total stock market. It's 30% of the total international stock market. And it's 20% of the bond market. It's a fairly conservative portfolio. And again, we get a nice graph, we get a nice pie chart. We get some nice numbers telling us that from 1997 till now, the Bogleheads free fund portfolio would have given us 6.63 around versus the S&P 820. I know which one I would have chosen. Looking at the graphs, we can see they're almost identical. They are very, very much correlated, which we can also see over in market correlation. They dip the same in the financial crisis. They dip kind of the same in the COVID crash. But again, when we see what happened here back in 2012-13, all of a sudden the S&P 500 just ran away. And that's because of the tech companies really, really hammering away at that time. We can look at the annual returns, how that looks. And again, the portfolio income, what it would look like, how much money it would bring in. Very nice. Oh, I just want to say that this is dividend and distributions. But you see how this can be used? I think it's a fantastic portfolio. And the only thing we've looked at so far is how to backtest a portfolio and different stocks. That's just one of the tools in here. We can also take a look at the asset class. We can, as just before, set the different parameters, just like we did before. Oh, stop, back it up. No rebalancing, no leverage, default. And then we can look at the asset classes. Like we just talked about before, that if everything grows, then we could go into growth and consumer discretionaries. Here we can look at what could we think, what would we like to look at. For instance, I hear a lot of people talking about emerging markets. Okay, then we're gonna go look at that. Should that be real emerging markets? Look at that as an asset class. Let's just say 30, let's say 25%. And let's say we want US complete stock market. No, we're gonna take large cap. And we're gonna take 25% large cap. We would like to have some, I would like to have some small cap too, actually. Small cap, let's just say 25 is a little bit ridiculous, but just for testing. It's just for fun. And I would like to look at, I'm actually looking for some bonds here, just to balance it out. Let's see how would these 4 asset classes have done right now from 72 till now. Let's see. Again, our nice little overview with our pie chart. We could look at the portfolio growth, and this time we're limited by emerging markets. Data is only available from 1995. But look at that, going from 1995, going into the financial crisis, going up to the COVID crash, and to the, I don't know if we should call it crash, but it is a crash, I think, right now. We would have gotten 81,000, almost 82,000, and 7.86 compound annual growth. That's not fantastic, you know? I mean, if we had done it like just saying we want large cap at 100%, of course, again, risk, a lot of risk associated with that. We would have had 1.3 million and 10.12 compound annual growth. So you see, with the willingness to take a risk and pick the right market, the willingness to take a risk also pays out. And as always, the best investment you can make is in you. If you found some value in this, I hope you will give this video a like, maybe even subscribe to the channel and help me out a lot. And on that note, I will leave you for today. Have a nice one. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the night inning. There ain't no point in resisting. Living